Do you want to hear directly from the ATO and leaders across the SMSF sector on the latest trends, tools, strategies and more to help you deliver seamless client experiences and generate impressive outcomes for your clients? The SMSF Advisor Technical Strategy Day will do exactly that. Our expert-led sessions will explore the changing legislative and regulatory landscape, arming you with the must-have knowledge to keep ahead, combat risks and reap new opportunities. Visit smsfstrategyday.com.au to learn more about our game-changing sessions and the experts leading them. Tickets are selling out fast, with only a small handful remaining in each state. Don't delay and miss your chance to attend.
This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hey everyone, and welcome to the SMSF Advisor Show. I'm Miranda Brownlee, and I'm joined by my co-host, Aaron Dunn. Hi, Aaron.
Hi, Miranda. How are you?
I'm good. And how are you?
Not too bad. We are closing in, of course, only a few weeks away from our SMSF Advisor Technical Strategy Days. So, yes, about to get on the road again.
Yes, it certainly is coming up fast. So that's happening throughout October, and we'll be visiting Brisbane, Sydney and Melbourne. So this is a big event for professionals working across the SMSF sector. Tickets are on sale now. So if you want to find out more about that, you can visit smsfstrategyday.com.au. And we've also got more information about the sessions and the raft of experts that will be presenting them.
Yeah, so from memory, I think we've had our last two have been online. So, and having been MC for a few years now, it's just going to be great to get back out in person like it has been with events in recent times. And the SMSF Advisor Technical Strategy Days do have a wonderful lineup of speakers, wonderful content. So if you haven't got a ticket yet, I certainly encourage you to do so. So, Miranda, as is always the way, what has been making news in our SMSF sector?
Yeah, so we've had a few different things happening, but we've had some sort of the ATO come out with a few comments sort of urging SMSFs, I guess, to sort of be prepared with their arrangements, particularly those that are perhaps at risk at being non-arm's length, with the PCG ending on 1 July. And I guess we've still got some sort of political uncertainty in that area, but they've sort of encouraging SMSFs just to be on top of it.
Yeah, so it was interesting. So this was the ATO Assistant Commissioner, Nadia Alfonsi, I think, spoke at the Tax Institute conference. And it was interesting because she spoke about like some of the issues to get out of the weeds, and let's try and focus on some of the bigger issues where NALI is intended to be. And the problem is of course, that we have our PCG in place, but we've got to go through and get the policy change that the former government had in essence promised us that they would do so. So the reality is it doesn't matter whether we're talking in weeds or we're talking about the core focus. As it stands right now, we have an unworkable solution. The ATO is hamstrung until there's policy change. And as an industry, the industry has been working together to try and get an outcome that could work. But again, we're just waiting for, of course, the government to naturally respond to those amendments in 295, 550. So we were hoping to see a couple of other changes, I guess, in the couple of weeks, I guess, where Parliament was meant to be sitting. But of course, with the Queen's passing, we've seen a deferral of that time as well. So there's a couple of measures that have still been stuck there. And yeah, again, we've just got to kind of wait and see as to when and where this ultimately lands around non-arm's length expenditure.
Yeah, it's not really sort of clear where it is on their priority list yet. So it is kind of difficult at the moment. And I guess from the professional's point of view, those sort of minor issues are still kind of concerning if it does taint all the income of the fund.
Oh, so, yeah, absolutely. Yeah, without question. There's the disproportionate approach that has is obviously quite significant, and therefore that is in essence the issue. But I guess the comment that was made was, the core focus of what the ATO really wants to deal with is the big ticket items around how expenditure and would apply, or the non-arm's length income rules would apply to non-arm's length arrangements, without actually saying, well, are we looking at washers, and how much should have been charged for a washer on a tap, and all those sorts of things. So, but absolutely, you're right. We're still talking about things like the accounting fees, financial advice fees, and so forth that connect itself back to all of the income of the fund.
Yeah, and we're also starting to see some more commentary around the proposals that were put in the Quality of Advice proposals paper. So we've seen the opposition, so Shadow Minister for Financial Services, Stuart Robert, sort of has a few concerns around the proposal to do with sort of extending the role of super funds in advice. And yeah, I guess he sort of highlighted issues around there being a bit of a conflict of interest there.
Yeah, so he's really, I guess, saying that there's some concerns, are we going backwards in terms of the steps where super funds, what's the role of the fund itself and therefore the trustee? And so I guess in opposition, he's saying he's not convinced, obviously, that the approach that would in essence introduce or allow super funds to come in to do this. Yeah, so from that point of view, I know there's been a podcast that Momentum Media did as well,
yes,
so that you can go online and obviously listen to and hear what the Shadow Minister for Financial Services actually said.
Yes, and we'll probably look to release a bit of a shortened version of that over the next week or so. So, that was with editor of Mortgages, Annie Kane. So we're also seeing with the rate rises and what's happening in the property market at the moment, there's a bit of impact on limited recourse borrowing arrangements. And we had Lynn Formica from Heffron sort of point out that there could be some potential compliance issues where people are holding onto a property just so that they avoid the bank claiming on a personal guarantee where the trustee has provided that personal guarantee in the past when they were taking out the loan.
Yeah, and that's a typical setup, what we'd see with LRBAs, where the lender has not only looked to secure the asset that's been acquired, but because of the limited recourse nature of only having security over that asset, then the bank or the institution, the lender, has looked to obtain guarantees externally. And therefore, as Lynn has rightly spoken about here, is that if we are seeing interest rates go up, which is putting financial pressures on the fund's capacity to pay, and then potentially the falling prices, which is impacting the LVR and so forth, we may come across various compliance issues. And naturally, one of the outcomes would be that the fund may be better simply walking away from the arrangement due to the limited recourse that the lender would have, but for the fact that then the individuals become exposed themselves. And therefore, will people continue to throw money at something that is kind of, banging your head against the brick wall only for the sake of protecting the assets that they have outside of superannuation because of the guarantee that's been provided?
Yeah, and it looks like there'll probably be another rate rise again next month, so it'll be definitely something to keep an eye on.
Yeah, and it's quite interesting because, naturally we're seeing interest rates go up. If you've got an LRBA, you're seeing rates move each month with a different institution. Yet when we look at our related party LRBAs, we have this set in stone amount from May each year, 1st of July, and then you in essence have that locked in. So it's quite interesting with a related party loan. We've got a 5.35% rate that was applicable from July, and we're not going to see another rate change complying with that safe harbour until July next year. And the jump then might be actually quite significant. So rather than talking about, 50 basis points this month and 50 basis points the next month and 25, the shift with a related party LRBA might move from 5.35 to north of 7 potentially, because of the fact that you're only seeing an annual increase or an annual change to the interest rate with related party borrowing arrangements.
Yeah, it might be a bit of a shock there.
Yeah, absolutely. And managing the cash flow, therefore, becomes really important.
We've also seen, with the government moving sort of ahead with the compensation scheme of last resort. We've also seen a bit of commentary around that. Associations aren't really happy about the fact that managed investment schemes have been excluded from the scope, particularly from the SMSF's perspective, as it means they're probably not going to be protected where they've invested in one of these managed investment schemes, and there's not really any way of getting compensation.
Yeah, and this goes back, with the Trio Capital arrangements and stuff that we saw in late 2000s, I think it was, off the top of my head. And, there was inquiries into that at the time. And in essence, there was a whole range of entities and MISs there that saw SMSF investors lose money through that, and the fact that, there was fraudulent activity through the scheme operator. And in essence, there was no real mechanism for those trustees that lost money through that process. So that's really the core issue there. And again, like you said, the SMSF Association have been quite vocal on that, as has the FPA around that exclusion of MISs from that compensation.
Yes. And speaking of investment losses, we've also seen Dixon Advisory and more hot water today. So we've seen them hit with a $7.2 million penalty for breaches of the best interests obligations.
Yeah, so it's kind of the gift that keeps on giving, isn't it, at the moment? So from a news story anyway for you, probably not for those that potentially lost money at that point in time, or Dixon, who's obviously paying out quite substantially now through penalties as well. But yeah, I would guess it's just a good reminder here of obligations of those that are obviously providing services and the teeth that ASIC has to obviously police that activity as well.
Yeah. So today we'll be speaking with Tracey Scotchbrook, Policy Manager at the SMSF Association. So she's going to be covering the sophisticated and wholesale investor rules, which is very important topic at the moment. It's also an area where there's a lot of grey areas and confusion. So she'll be taking us through some of the definitions and providing some tips for practitioners, particularly in relation to SMSFs. Hi, Tracey. Thanks for joining us.
Hi, Miranda. Thanks for having me.
So today we're going to be talking about sophisticated and wholesale investor rules. It's quite a complex area, and I think the association sort of pointed out previously there's been a little bit of a spike with wholesale and sophisticated investors, with sort of the complexity of advice increasing and the burden around that. Can you just start by giving us a bit of an outline about the wholesale and sophisticated investor definitions and where they might apply for SMSF clients?
Yeah, look, it's quite a big basket of goods because there's quite a few different tests and ways someone can be made either a wholesale or sophisticated investor. So without getting bogged down too much in the legislation, the key areas that people need to look at are Section 761G of the Corporations Act. And here we have the wholesale investor definitions. And what it says here is that a client will always be a retail client unless they satisfy one of the tests under 761G or 761GA, which 7GA brings in the first of our sophisticated investor rules. So we start as a retail client. We then need to look whether the tests are passed. But importantly, if a client's been advised as a retail client to begin with and they've acquired a financial product or a service as a retail client, it will forever remain a retail client, whether they've invested in that product directly themselves or through a previous financial advisor. So it's really important to be aware of what your clients have, how they've acquired them, even though you may not have necessarily advised them on that. So it gets confusing because there are a broad range of different tests that apply. So, for example, there's a $500,000 investment threshold test that can be applied. But when we look at the wholesale client rules, that expressly carves out superannuation funds because it says superannuation source monies can't apply. But when we look at the sophisticated investor rules under Section 708, we have something that's quite similar, which an SMSF could use to invest in financial products. And importantly, it is specific to a single investment that the fund will make. Similarly, mirror between the two tests, we have the $2.5 million net asset test and the $250,000 income test. And we see this mirrored between wholesale under 761G and also under the Sophisticated Investor Rules in 708 Part 8. But importantly, we also have a rule for professional investors and superannuation trustees, which has a $10 million net asset test. And this is where things start to get a bit murky, because we know account certificates and the use of the asset test is a popular method used in the SMSF space. ASIC's guidance had previously said that the $10 million net asset test would need to be satisfied by an SMSF trustee in order to qualify to utilise these rules. Back in 2014, they issued a media release which said that if the $2.5 million net asset test had been applied, that they wouldn't take any compliance action. So they're not saying that it's okay to use a $2.5 million net asset test, but they're saying that they won't take any compliance action. So the risk for accountants who are providing account certificates and those that are advising the client, so from the advice side, the risk is that if there is an issue, there is a complaint, someone suffers a loss, that they could actually take legal action or engage in some formal process to seek compensation if they do suffer a loss. So it does get quite murky when we start to look at those particular threshold tests.
And Tracey, it's all here about disclosure, I guess, in one instance. And then It's also just about the fact that we've seen the value of assets generally, thinking about property and so forth, that have increased, that we've now seen a much greater catchment of people arguably fall either within or much closer to this definition, which is really why we've seen such a heightened level of activity in this space, because all of a sudden $2.5 million in today's value when comparing to a decade ago is a very different kettle of fish.
Yeah, totally agree. So house prices alone are one example, and the fact that somebody is a homeowner and they've had the good fortune to buy in a suburb that has had significant growth in value is not necessarily a measure of their sophistication. And indeed, under the both 761GA and 708 Part 8, there is a provision in there that does allow for an A for sell to determine whether or not someone has the requisite knowledge, experience, expertise and capabilities that makes it appropriate to be classed as a sophisticated investor. Now, there are certain segments of the marketplace that use that particular rule where the A for sell signs off, but more often what we're seeing is where the licensee or the advisor is seeking to use the accountant certificates test, and that's where we start to have concerns around some of the activities that we've been seeing and going from the queries that we're getting from our members.
Mm. So I guess we've touched on a little bit, but what are some of the grey areas with sophisticated investor definitions that people need to be aware of when it comes to self-managed super funds?
Yeah, so first of all is the uncertainty around that $10 million net asset test.
Yep.
So we need to have legislative certainty around that from an SMSF context. The other is in how the asset tests are applied within an SMSF context. So often will people look and see that there's a member within a fund that has a certain level of balance and look to perhaps use that to satisfy the test. But what we need to be careful of is how the preservation rules will actually apply, because unless that person has met a condition of release, that individual as a member of the fund can't incorporate their superannuation balance within that test. So then we're having to look at it from a trustee perspective, and it starts to become a little bit more complicated fairly quickly when we look at how the rules apply, because the rules are going to apply slightly differently when we've got corporate trustees as opposed to individual trustees. So it's a lot more straightforward where a fund has a corporate trustee, where the fund itself meets the asset test and it has what's called a controlling individual, then the fund can meet the test. But then we have to look at this definition of who's a controlling individual. And when we look at how that's defined in the legislation, it's not what you might think. So it might not necessarily be someone who has control as a director or as a shareholder. It looks at the actual practical influence that someone actually has over the fund. So that suddenly becomes a little bit more difficult to demonstrate.
They're very subjective, isn't it?
It is very subjective, whereas a legal test based on a shareholding and so forth, you've got some very clear, hard parameters that you can work to.
Yeah, and so a constitution or a deed, we know in SMSF land, is very different. In some look at voting rights by one shareholder, one vote, and there are others that obviously look at it based upon dollar of account balance. It's just an example that could throw up some very different outcomes.
Yeah, exactly. And look, unfortunately, in having a look into this, trying to find some examples that are out there as to how can someone demonstrate that practical control, there's
Doesn't
nothing.
exist.
I couldn't find anything. So if anybody's found anything out there, I'd love to receive it, so send it through. But this is the issue. How do you demonstrate it? What is going to actually meet that particular bar?
We've obviously got a couple of reviews that are kind of looking at this area. I mean, obviously the quality of advice review, it's only looking at it in quite a limited scope, but do you expect to see any kind of clarity from either the ALRC review or the QA review in this area, including that $10 million test?
The ALRC, look, it's unclear. I don't think we're going to see a lot of reform come from that particular inquiry or review. For the quality of advice review, we do have a limitation because of the way the terms of reference have been structured. So the wholesale sophisticated investor rules are carved out from the terms of reference. We do have one little toe in the water around the consumer or client consent arrangements. So that's what's included in the quality of advice review. Despite this, we know that from conversations with Treasury that Reviewer Michelle Levy has the opportunity to make recommendations on the matters that are in the terms of reference, but can certainly issue findings around those areas that are not included in the terms of reference. However, I think where we might struggle is just the breadth of issues that are being addressed and what has had a light shone on it from the initial consultation phase. It may be difficult just practically for us to see any sort of real reform come from the quality of advice review. It is an area that probably does need to have a spotlight on it and have a wholesale review, if I can say that, because the last time there was a formal consultation around these rules was back in 2011. So it was a Future of Financial Advice review back in 2011. There were a lot of concerns that were raised back then, issues around superannuation and SMSFs, whether the asset tests were appropriate. There's no indexation around the assets and the income tests. But unfortunately, nothing ever flowed. There were no outcomes from that particular review. So look, the association would certainly welcome a more detailed review of this to make sure that it's fit for purpose.
So are there any other, I guess, practical issues or risks and stuff that you see in the area that accountants and advisors should be aware of? I guess given that we sit within this grey area probably is the best way to phrase it at the moment. So what would your advice be at the moment to them in terms of the way that their accountants are signing off on this and the way that advisors should be discussing these with accountants that would be needing to sign off on these to verify for clients?
Yeah, so if I start with the accountants first, we've seen some interesting activity that's been reported to us from members where they've had clients or people approach them who are not clients, so people they've not dealt with before, seeking to have a certificate signed off. This is a concern, given the nature of what's being attested to and the importance of it. Whilst the accountant is providing a statement of fact around someone meeting a test, they still do have a professional ethical obligation to make sure that certificate is correct and that it is appropriate in the client's circumstances. So recommendation would be unless you know the client, perhaps decline the engagement. Do keep good records. Records are going to be important to show how that client has met the test, where you are agreeing to sign off on a certificate. And it's important that the client understands why they're being moved into that sophisticated or wholesale environment. So whether they're an SMSF client, an individual client, the same process should be being applied. You do have an ethical obligation under APES 110 to make sure that you're providing a statement that's true and correct and not false. And you have duties to make sure that what you're signing or the service you're providing is in the client's best interest. So do be aware of that. Do check with your accounting professional bodies, noting that it's only someone who's a member, a specified member of the CPA, Chartered Accountants and IPA can provide these certificates. So it's important that you're aligning with what those professional bodies are recommending and requiring of you as well. From the financial advisor's perspective, you do need to consider the financial advisor's code of ethics. Anytime you're moving a client away from a retail client environment, the consumer protections that do come into play, you need to carefully consider whether or not that's appropriate in the client's circumstances, because that client will be deemed to be a retail client first under the law unless you're moving them away. So be really careful to make sure that it is appropriate in the client's circumstances, that they do understand why. So when they, again, digging into that code of ethics, systems processes are going to be a really important one. So you need to make sure that if you're advising clients who are both wholesale sophisticated and retail clients within your client base, that they're clearly identified in the way that you engage with those clients is appropriate, because once someone is a retail client and once a product has been placed as a retail investment, then it will forever be in that retail environment. So it does require some careful planning processes, procedures to make sure that you're engaging with your clients in the right way.
And document.
Absolutely. For both the accountants and the advisors, that is absolutely paramount. Yep.
You've covered a lot, but are there any other kind of common queries that you get from members that you wanted to cover?
Yep. So one is around how the assets test will apply where there's individual trustees. There are different legal opinions on how that is to apply. So I mentioned earlier about the corporate trustee, where it's fairly straightforward. We've got a company and the fund itself meets the test. So long as we've got that controlling individual, then the fund itself can be used or the fund itself will make the test. Importantly, the fund can't be used to help the individual meet the relevant test. It'll just be the fund itself. When it comes to individual trustees, as I mentioned, there's different opinions on how that will apply. There are some that say when we've got a controlling individual, that individual trustee can then utilise the assets of the fund for the fund itself to meet the test. And then there's others that say, no, individual trustees, it's different. You need to be dividing the asset base of that fund across the number of trustees. So you could have a fund that's got $3 million in net assets, but because we've got 2 or more trustees, it's not actually going to meet the test, even though we've got that controlling individual and the fund itself meets the test.
So that's, Tracey, regardless of the quantum of money per member, it's just a straight division by the number of trustees.
Yep. So as I say, that is one opinion. There are different opinions, but just make sure you are documenting, as we said before, what you're doing and the rationale for your decisions. And it does need to be looked at from the trustee level, not the member level. And I think that's probably the biggest sticking point. One other thing I think people need to be aware of, whether it's the accountants or the financial advisors, is the trustee obligations here. So looking at 52B of SIS and the trustee covenants and what applies there around investment strategies. So making sure that they are structured in a way that's appropriate, considering how the fund is going to be investing. Is it appropriate for the members of the fund? And where you've got pooled investments and you've got a member in the fund that has a much smaller balance, is it actually appropriate? So whilst the fund itself might satisfy the test, is it appropriate where you've got that smaller balance for that other member, or indeed someone perhaps where you've got one member in pension phase and someone in accumulation phase? Those sorts of considerations. Is it appropriate whilst the fund can meet the test, looking across the members of the fund, is it actually appropriate?
Very good. Well, thank you once again, Trace. It's you're a fountain of knowledge, as is always the way. So, but it is certainly an area, like you said, that you would naturally get a lot of questions on. I know you recently covered it in a lot of detail at the SMSF Technical Summit up on the Gold Coast, which was the reason why we wanted to really get you on, to help our audience try and just get some base level of understanding, because, as you rightly said, there's a lot of confusion that still is out in the marketplace and probably still will be for a little bit of time until we see some sort of steps forward that allow us, in particular in SMSF land, to get some greater certainty. I know the SMSF Association is certainly advocating for that, and you're doing a lot of work in the background. So from all of us here and to our audience, thank you for being a part of today's session. It's been great.
Yeah, thank you. My pleasure.
Thank you.
So, Miranda, that was a fascinating conversation with Tracey. It's certainly an area that lives up to its title of being sophisticated, doesn't it?
Yes, it certainly does. It's funny, once you start getting into it, you realise how many little facets and different tests there actually are part of this area. And I guess there's a lot of risks because of that. Yeah.
So what was the key takeaway from you for that discussion with Tracey?
I think she had some really good tips there, but just sort of emphasising it's important that the client is informed of why they're moving into that sophisticated or wholesale investor regime, and the importance of keeping good records and file notes as well.
Yeah, so that professional bit for me really stood out because it's, they can come as an accountant, it can come across your desk pretty regularly from an advisor or whatever, just can you sign this, or a broker or whatever, and understanding the risk that sits behind it in respect to the liability of the professional that's signing off on that. And whilst we maybe haven't seen a lot of discussion around that I guess that risk is sort of bubbling underneath the surface. So document. I think I said, during that discussion with her, and Tracey's sort of shook her head vigorously saying, yes, absolutely, that should be the case. And yeah, so just a real belt and braces approach there was the real key takeaway for me. So as is always the case, Miranda, when we think about future topics and speakers that our audience would like to hear, how can they get in contact with us?
They can get in touch at editor@smsfadvisoronline.com.au.
Excellent. Well, thank you, everyone, for joining us again for our SMSF Advisor Show. We hope you have a great rest of the week, and we'll see you for our next episode. Take care and bye for now.
Imagine being rushed to hospital.
Yep.
And your life changing in an instant. Imagine going through hundreds of tests and 46 weeks of chemo. Now imagine you're a child. That's why Starlight exists, to bring happiness to seriously ill children. Please donate at starlight.org.au.